All right, everybody, welcome to our latest podcast here, the Minds of Markets podcast. And yes, we have an amazing special guest here today, someone that you probably have seen on any number of financial networks because she is on, I think, pretty much on a daily basis or read about her. I know many of her articles are published. She published a book. So Carley Garner, this is actually an honor. You and I have been on some other shows together, but we've never really had this kind of conversation. So let me give a brief intro to everybody on who you are, although most people probably know who you are here. This is a heck of a script, everybody. This is one that's hard to follow. So Carley is a futures and options broker with DeCarley Trading, a division of Zener Financial Services in Las Vegas. She has nearly 2 decades of experience in our commodity market analysis, as I just mentioned, often referenced on Jim Cramer's Mad Money on CNBC. She's a regular guest with Abigail Doolittle on Bloomberg. And you can see her on the Cow Guy Close, which I think you're doing later today. And I have the follow-up to you tomorrow on there. And then you also are a regular on a futures segment at the Schwab Network. I know you are a regular contributor at thestreet.com, and it's Real Money Pro Service, and is also a regular on the speaking circuit. You can be found at traders expos, money shows throughout the country. You're an award-winning commodity futures and option trading book author. We will get into that because I want to learn more about that. I know you have a very loyal following, and you know, I'm not just saying this, I'm not just, let's say, blowing smoke here, but everybody that I talk to in this industry, if your name comes up, you know, it's cream of the crop. That is the really how people describe you. So it is awesome. One thing that scares me a little bit, you went to UNLV. You graduated magna cum laude. I mean, Unbelievable. You have dual bachelor's degree in finance and accounting, and you've been doing this now for almost 20 years. Does that sum up your life in the last 20 years or so?
That was awesome. Thank you. I appreciate all the kind words. And it's interesting that you and I haven't spoken more because I swear to you, every time I'm booked on some sort of segment somewhere, you're either before me or after me. It seems like almost every time. So we run into each other a lot.
We do, and it is nice to finally catch up. You got into this business a little bit after I did, so you got in. You know, you're a 20-year vet. How did you get into this? I know you studied business, you studied finance, accounting, but what brought you into the world of brokerage and specifically commodities?
You know, it's not that exciting of a story. I was one of those people that took the scenic route in college. I switched my majors a few times. I started going into medical. I was going to be a physical therapist. And then it finally dawned on me that you have to touch people to do that. And I'm not really the type of person that wants to touch strangers. So that was off. And then I ended up finding the right place for me. It just took a long time. But in college, I did an internship at a stock brokerage. I thought that's what I wanted to do. And then when I got there, I realized, you know, this is just a really intense sales industry. You know, it's a glorified sales industry. And I'm not the best salesman. And I knew that just was not something I'd be happy doing. Ironically, my job is still sales. It's technically what I do, but it's a little more exciting on the commodity side of things. And the best part of my job is helping farmers and ranchers hedge their price risk. So instead of just speculating and investing and things like that, we do a lot of price hedging, which makes me feel pretty productive. And so I love my job. I love what I do every day.
Lot of added value there, and that's why you're one of the stars with Scott Shelley at the Cow Guy Close, because that demographic is right up your alley there. So in 2004, you graduate, worked for, you know, a broker. How did you get to where you are today though, right? You don't just say, I'm going to go out on my own. I'm going to start running my own business. There had to be a little lead up, because I know for me, when I started trading back on the floor of the SIBO, which was back in 1991, I was a clerk for a little bit. I had some backers put me on a seat. And then eventually, a few years later, we became partners in a big firm. So, there's a progression there. What was it for you?
It was a long, hard fight. I mean, I don't have enough time to tell the entire story, but let's just put it this way. I started out in a smoke-filled office, smiling and dialing, cold calling, like, really the base level sales type of job. And at first it was a turnoff, but then I thought, let's give it a shot. And in this business, it's commission based. So there were like 2 or 3 periods in the first handful of years of business that I didn't get paid for 6 months at a time. So it's a really, really tough business. But for those that have the ability and the willpower to do it, it can be very rewarding. And I'm glad that I stuck with it, even though it's been a roller coaster ride. So far, up until this point, I'm glad that I've went through all that to get to where I am today.
Well, it's definitely a grinded out business. And, I'm sure just like, maybe looking at a chart, you probably hit that resistance, and then boom, you broke out and look where you are today. So nicely done on that. Did you grow up in Vegas? I mean, because I know you went to UNLV, you're there now.
I did not. I grew up in Utah, so just one state away.
Okay.
Vegas was a way to get out of Utah, but still be close enough to visit family. So it was perfect location. And as it turns out, I love it. So I'll be here forever. I'm never leaving.
That's awesome. That is awesome. So let's talk about, the commodity space here, which that's your baby. And obviously there's been no lack of volatility, no lack of excitement in the commodity space, pretty much across the board, whether we're talking, energy or metals or grains. Where have you seen the most volatility? I'd say just let's even this year. So the first quarter of this year, first 3 months of this year, in which sector, commodity sector, have you seen the most action, most volatility?
Hands down, the softs have seen the most volatility. So we're talking about orange juice, cocoa, coffee, even cotton. Some of those most people are paying attention to cocoa because that's the one that's just off the charts. Yeah. And, not in a good way. I love, commodity market volatility is a good thing for producers and hedgers usually, sometimes, not always. But I think this is a little too much of a good thing. I think there's more people getting burned on the cocoa trade than anything. I mean, we can get into that if you want, but I think the exchange has made some mistakes. They kept margins really unlogically low, and it allowed too many speculators that maybe aren't familiar with commodities to get involved. And I think a lot of people felt a lot of pain in this situation. This is different than when I first got in the business. Not everybody had access to the commodity markets. Futures and options were, there were some barriers to entry. It was a lot tougher, or a lot more legwork to open a commodity account. But nowadays, anyone that has a stock account can apply for a commodity account really quickly, and they have access on their phone. And so I think some people just, they're not experienced enough, or just don't understand what leverage is and how it works and how dangerous it can be. And I think that, commodity market volume and volatility is a good thing, but only if the people participating are educated. Otherwise it can ruin some people's lives if they're not careful.
Oh, there's no doubt about it. And I think that's not only in the commodity space, it's also on the equity space.
Sure.
And risk management and also understanding the leverage are really the two, in my book, the two most important things that you need to understand. But things in the commodity space usually work a little differently than they do on the equity space, because in the commodity space, there's always a big skew to the upside. Although, in some of the NASDAQ stocks, there has been a big skew to the upside recently, but there's always that big skew to the upside, right? For the what if. And I have to imagine, especially thinking about, what's going on with cocoa, there's probably a lot of people, a lot of funds out there that have been caught short that just don't know what to do.
Yeah, I mean, cocoa spent a decade trading between 2,000 and 3,000, and then next, suddenly we're in the 7,000-8,000s. People that know how commodity markets should, quote unquote, should work, and that's a loose term, probably suffered in this more than, what I mean? It's the traders that maybe don't have a lot of experience and don't know that cocoa shouldn't go from 3,000 to 8,000 in 3 months. Those people are probably making money, but unfortunately, people that that have been around a while are probably the ones holding the bag.
Yeah.
We've seen this in GameStop. We've seen this in, kind of wave throughout the commodity and financial markets. And I mean, there's a lot of reasons for it, but one in particular just being all the additional cash that was pumped into the economy. So it just opens the door for speculation. And in my opinion, I think that's a lot of what we're seeing. A lot, we saw this in commodities, kind of like it started with copper, natural gas, lumber, and then it kind of rolled through all the commodities, and we get that speculative money that gets poured in. Regardless of fundamentals, regardless of reality, right. It's just that money needs to go somewhere, and people are buying commodity ETFs, which I'm not a big fan of, because what generally happens, a lot of them basically pull investor money and then buy futures contracts with it, which sounds like a great idea because it gives people that wouldn't otherwise have access to those markets access.
Sure.
But the problem is sometimes those ETFs get too popular. Maybe they're like, for example, when Ukraine and Russia went to war, the wheat ETF got way too popular, too big for its britches, too much money came in, and then that money had to make its way into the futures markets, but the futures markets weren't big enough to absorb it, and it just caused pure chaos. And we don't want to see that. We want price discovery to make sense in the end. Right. It doesn't have to make sense in the short run, but eventually it does. And when you see wheat go from $5 to $14 back down to $5, that's a sign that something's broken. Yeah, right. Something's not right.
So last thing on cocoa, because I'm interested in this, and there's probably a lot of people that are interested. The fact that, price of cocoa has gone 2-3x. What does that mean for the price of chocolate? What does that mean if I want to go buy a Hershey's candy bar? Is there a direct correlation to that?
It lags quite a bit. Just like a year and a half, 2 years ago, natural gas was at $10. Now it's at $1.80, but guess what? Our bills haven't gone down, and that's because there's a really big lag component there. If these prices were going to translate into the actual consumer market, I mean, we're probably talking like $15 candy bars, So the thing is, these types of things can happen in the cash market and in the futures market as everybody's trying to adjust, but the consumer's probably not going to pay up for that. So there will be demand destruction. High prices always cure high prices, but it takes quite a while for that to work out of the system. I mean, we're probably a couple of years down the road before things normalize. That said, I've seen this before. We saw it in natural gas. We saw it in lumber. We've seen it before. I would not be shocked to see cocoa trading 3,000 or maybe even below by the end of the year. That's just how these things generally work out. And it's really sad because anybody that lost money on the way up, maybe they were on the wrong side of it. They're probably not going to be there for 2,000 cocoa this year or next year. Yeah, They just can't. They run out of money. And then on the flip side, the people that have made money on the long side probably won't get out soon enough, and they'll probably get burned as well. So it's, in my opinion, it's a lose-lose.
The dynamics of the market. And now that we're talking about predictions, you are on record, because I've read a few articles about this recently, about your gold prediction. And you have historically a unbelievable track record of predictions. So I know recently you just said, look for 2,600 gold. Maybe we get a little sell off first. Mm-hmm. Why do you say that? Is it more the economics of safe haven? Is it geopolitical risk? What is it that you see gold, extending those all-time highs up to 2,600?
Well, there's a few things I'm looking at. For starters, the current scenario in gold reminds me a lot of like 2010, 2011. So a couple of years after the financial crisis, all the liquidity that was pumped into the system, it took a couple of years for that to make its way into gold and silver. And I think we're going to get a repeat of that. So I think it's more of a catch-up trade. Gold had every reason in the book, textbook definition, inflation, economic uncertainty, turmoil, and overseas. I mean, we had all these reasons for people to buy gold, and really gold didn't budge. But I think that at some point we're going to break up above, highs. We're already in the process of doing that, and I think we digest maybe in the short run. But in the long run, 2,600 is what my weekly chart has pointed out, and I think that's probably where we're going, just as a catch up to the fundamentals that we've seen over the last couple of years that hasn't moved gold yet, but should in the future. And it's important to note that gold is not the kind of market that you just buy and hold forever. I mean, those traders in 2011 that bought the highs had to wait a decade just to get their money back, if they're holding on to gold that long. It's one of those markets that does nothing for years, and then makes its move all in one swoop. And I think we're just overdue for that one swoop higher. So we'll see. It's going to be interesting. It's not an easy market to trade because once you missed it, you missed it. But
Right.
there's some opportunities there.
Right. I think there's a lot of, when, like you just said, when you miss it, you miss it. There's a lot of, I'll wait for that next pullback to get in. And then that next pullback never happened. So, well, that is very interesting. And speaking of your calls, again, you're on record of the big call last year of a big bull run in the equity markets, which certainly happened. And then I was just reading just the other day, based on that call, you were asked, what's your outlook for the NASDAQ? And that maybe wasn't as rosy right now. And does that have to do with the euphoria around AI pushing things up? Does it have to do with the Fed not coming to the rescue of the market and lowering rates? What do you see, for those NASDAQ stocks in the NASDAQ area that, makes you maybe a little cautious here?
I feel like there's a lot of irrational exuberance built in the markets. We can see it in Bitcoin. We can see it in tech stocks. These types of environments are generally unsustainable. What I'm seeing in the NASDAQ is very similar to what I saw in 2021, late 2021, after the big COVID reopening trade. And to be honest, I mean, we don't know. We don't know what the future holds, but there's a lot of technical resistance overhead in the NASDAQ. Everybody seems to be bullish and long. Some of the sentiment polls that I follow are suggesting that 80% of insiders, and this isn't retail traders, this is industry insiders, so brokers and analysts, 80% are bullish the NASDAQ. And when everybody has the same idea, that's generally, I get nervous. I mean, if you remember just a year ago, everybody assumed we're going into recession and nobody should own stocks, and now it's the exact opposite. So I'm a little worried about the stock market and the NASDAQ in the short run. I'm not looking for Armageddon, but a really healthy correction would be exactly what this market needs.
Well, what's really unbelievable, at least on my side, because I'm all on the equity side, especially options, is I mentioned earlier. You look at some of the NASDAQ stocks, Nvidia, name any number of them. And the option skew is so far tilted towards the upside, towards the call side, which is not typical. And I've seen this now for the last cycle of earnings, probably the last 3-4 months, that this skew to the upside is it's almost as irrational as it was back in the 2000 .com bubble, and maybe even more so now. So given what you just said about the insiders, 80% of them saying, we like this here, that's what the retail side is saying also. If you look at the retail order flow, to some of these upside call positions. So being experienced in this industry as you and I are, and we look to potentially take that contrarian standpoint there, that could be another reason why maybe you need to be cautious and fade this market a little bit.
Absolutely. And I thank you for mentioning the options, because I was just thinking the other day, there was about a decade of my career when it was almost impossible to make money buying call options in the E-mini S&P. Options are priced to lose, and call options were literally, if you sold them, it would be really hard to lose, and if you bought them, it would be really hard to make money. But it's the exact opposite now. If you're trying to sell calls against this market, you're just getting run over. So it's such an odd environment than what maybe most people would consider normal. And again, I just think those types of environments are unsustainable. And the sad reality is, in the end, all this, speculation without minding the risk. I feel like people are very, very complacent, and they're not protecting themselves and not adjusting for maybe what could be around the corner. And if that's the case, again, just like we saw in some of the commodity boom and bust, people can really get burned on this. And if that's the case, it pulls a lot of liquidity out of the market. People start losing faith in the markets. And so it creates a very slow period of time. And so I wouldn't be shocked. We've seen a lot of shock and awe in both commodities and stocks the last 4 years or so. I wouldn't be surprised to see a dead market for several years, just literally churning and trading sideways. And to be honest, that's probably what we need to just work out all of the froth.
Yeah, one thing that I always tell not just my clients, but when I'm on one of my interviews is, protection. Buy when you can, not when you have to. And
Mhm.
I try and use the analogy of, when someone tries to reprice or go out and get a new premium for their auto insurance, their homeowners, you're always pricing. You want the best deal out there, and
Right.
you buy it and hope you never have to use it, right? Well, that's
Mhm.
the same that I look at as protection in the marketplace. And especially when we're at some lofty, frothy levels in volatility, historically, it's still pretty low. It's up from where it has been, but it's still pretty low. People to me that won't, just protect or hedge themselves right now,
Mhm.
that's a recipe for disaster.
It is, and it's painful. And, all of
Yeah.
us have the same desire to retire at some point. And if your timing's off, a big sell off can really thwart that. What we're encouraging our clients to do is if they do have a nice, a sizable stock portfolio that they want to hedge, they're doing well on, but they want to cash out. They don't want to create a taxable event. They still want to earn dividends, all those sorts of things. We can help them hedge it in the futures markets by basically using risk reversals. And it's the idea is we sell call options above the market and then use the proceeds to buy puts. That way they have free insurance, puts a floor in their portfolio under a certain price
Yep.
level. And all they're doing is giving up some of their upside gain. In most situations, the calls are overpriced enough because of the things that we've just talked about. You actually, the odds of the S&P rallying to above your short strike on your call is not really that great. So honestly, you're not giving up that much upside potential because we've probably already seen most of the upside potential. The risks on the downside. So it's something to think about.
Yeah, risk reversals for those of you that don't know what that is, you can Google it, you can look it up. It is a fantastic hedging strategy.
It is.
Let me shift gears here. I know you published a bunch of books. One to me that really stood out. If you can give us all the little bit of an overview, was one called Higher Probability Commodity Trade. Everybody always looks for that higher probability in the trades. One thing that I run into with my students or with other things people will find on the internet is, yes, I'm going to make a trade with high probability and I'm going to win 95 out of 100 times. Great. But
Mhm.
what people don't understand is that 5% wipes out the 95 wins, right? So you're making pennies, and your track record looks fantastic, but at the end of the day, you're going nowhere.
Yeah.
So with higher probability commodity trading, what's the secret sauce there? What are you doing to get higher probabilities
Right.
and maintain consistency?
Well, the premise of that book is is market analysis, and it's not rocket science. It's really simple. I like to keep things very, very simple. Basic trend lines. I'm not doing any calculus or anything here. But the important thing is most people forget, like they either focus on charts or they focus on fundamentals, but they don't focus on both, and they often ignore seasonality. They often ignore market composition, where traders are today. Like, are they long? Are they short? How much? And so that book kind of takes you through the process of what we look at. We're looking at charts, then we're looking at seasonals, then we're looking at the COT report that's issued by the CFTC to see where traders are positioned. And then we put all of that information together. And it doesn't guarantee that you're going to pick the right direction, but it gives you a pretty good heads up on what may or may not happen. And it also, I share a lot of, good, bad, and ugly stories in there so that people realize that it is speculation. It's not investing. You're not guaranteed to make money. I talk to a lot of people that kind of work on the assumption that if they put in the time and the work that the market owes them some sort of return, and that's just really just not what it is. And it also is, in my opinion, it's mostly a mental game when it comes to speculation. I'm not talking about investing. I'm talking about speculating. It really is a mental game. I can give two people the exact same advice, and one person makes money off of it, and one person does, loses a shirt on it. Same
Sure.
advice, same information, but it's just the way that they react to different scenarios. So in that book, I try to basically kind of lay the groundwork for what you can expect, the emotional side of things, the analysis side of things, and hopefully I did that. Hopefully I accomplished it.
That's awesome. And I highly recommend everybody that is interested in the commodity market at all to take a look at that. And where can they get that? Amazon or favorite?
Yeah. Yeah, honestly,
So,
it's available anywhere,
yep.
but Amazon's the cheapest. I'd recommend Amazon will ship it to you for free. Can't beat that.
Awesome. Awesome. Any parting words of wisdom for our listeners in the run up across commodities that we have seen recently, or quite frankly, the general market? I mean, we have the Fed, which is front and center, and a lot of geopolitical uncertainty, and of course, the election coming up in November. So there's a lot on everyone's plates here.
There's a lot going on. A couple things that I'll just mention in passing. This seems obvious to people that have followed commodities for years and years, but I've found that it's not as obvious to people that are just kind of starting to get involved. And commodities are not stocks. They don't trade. They don't trade higher over time. Like stocks are pretty forgiving, especially the indices. Your timing can be awful, and if you just stay long enough, it eventually will work out because stocks are designed to go up. Commodities aren't like that. Commodities are actually designed to trade sideways, or believe it or not, commodities go down more than they go up. So you want to be really careful trying to implement some sort of buy and hold strategy, unless commodities are just really, really cheap. Unless you're looking at something like natural gas under $2, that might be one to consider long-term buy. But for the most part, it's a base hit strategy and in and out. If you make some money, get out and take it. Always protect yourself. And as far as the stock market goes, we don't know nobody knows what's around the corner. But all I can say is, it's been my experience. Anytime things feel too good to be true, when I start checking my 401k balances and it's, makes me smile every day, that's when I kind of tap the brakes. I think, maybe I should pull some of this back because things are just going too well and they don't always continue that way.
Do you manage your 401k or your investments? Because I know I don't. I learned the hard way a long time ago that the trader mindset is the worst thing you could do to manage your own portfolios. And I learned, 20 some odd years ago, that was a disaster.
I agree with you 100%. I do manage all of my own money, but I keep it really, really basic. I try not to even tweak it unless things are extreme. Like right now, I've actually pared back. I'm holding I think the last I looked, my portfolio was only 20% stocks and everything else bonds and cash. So I do those sorts of things. I've gotten burned a couple times, but it's worked out in my favor more than it hasn't. That said, it's not a good idea. You should probably just set it and forget it and not look at it. So probably it might be beneficial for me to do what you're doing, but I haven't gotten to that point yet.
Yeah, my trader mindset as yours may be is, a matter of seconds, minutes, days, not months and years.
Correct.
So
yeah.
that's a recipe for disaster. Well, Carley, I don't want to take up any more of your time, but I can't tell you how much I appreciate this. And not just for all of our listeners and viewers here, but for me personally, because as we said, we've never really had the opportunity to sit down and have a conversation. And I'd love to do it again offline at some point. And just thank you. I mean, you are, your resume is sterling and your reputation. If there is anybody out there that wants to follow Carley Garner, follow what's going on in the commodity markets, I couldn't give less than 100% or 10 stars to do that.
Thank you. I appreciate it, Scott. It's been fun.
Thank you very much. Have a great one, Carley.
You too.
The Minds of Markets podcast is an exploration, a deep dive into the minds of some of the best traders and investors in the market. Our goal is to help you, the listener, learn from some of the best out there to improve your knowledge and skill set as a trader or investor. The Minds of Markets podcast should be used for information and entertainment purposes only. The opinions expressed in this podcast are our opinions only, and none of the information contained in this podcast constitutes a recommendation that any particular security, portfolio of security, transaction, or investment strategy is suitable for any specific person. Trading is risky, and past performance is not a guarantee of future results.